All right, and we're back. If you're just joining us, I'm sitting down with Greg Riordan of Legacy Mutual Mortgage here in Prescott, Arizona. And right now we're going to talk about what you as a buyer can do to get yourself financially prepared and have a strategy before you even make an offer on a house.
Awesome.
So let's dive into it. Just straight up, I'm looking for some tips and maybe some secrets out of you.
Okay.
I don't know. They're not really secrets, but things that like a buyer wouldn't know, right?
Sure.
So what can you tell us regarding improving a credit score for a buyer before they buy a house?
There's all these great apps, right? Everybody's like, hey, Credit Karma says this, or my credit card gives me my credit score. Those are all great, trends. They're not really accurate as far as what your credit score is. So we're going to have to do at least a soft pull on that credit just to see what it looks like. But if you kind of have a bearing of if it's bad, right? If you have a 500, right? So I would say seek some credit counseling because you still have another 100 plus points to, maybe 200 to get yourself in a good position to buy. You don't have to go to 700, but you're going to get better rates than a 620, right? Mm-hmm. And so you really want to prepare yourself for that. I would say seek a credit counselor if you're that low. Now, if you're close, simple things you can do. Go to a credit union, get a shared savings credit account, right? And shared installment loan. And they'll report it to your credit report, and that really boosts your credit over the next 6 months. It's unbelievable. It's more so than getting a credit card, using it for gas and groceries and paying it off. So I would say that's number one tip.
That's interesting.
If you're going to improve. Yeah, it's unreal.
So it's like a personal loan?
Yeah, so say you just give them $1,000 and then you're borrowing it back and then you're paying it back.
Huh.
Yeah, so it's a personal loan with your own money. But they report
Interesting.
it. So if you're that low, I would say go do that. Even if you're in the 600s, low 600s, still do that. Mm-hmm. It's amazing. Yeah, I would say, use your credit cards for gas and groceries, pay it off, because that is the gas and the fuel for credit scores to go up, right? You can't just let your credit sit stagnant. You have to utilize it so it moves. Now, don't let it get out of control. That can happen, so be very mindful what you're using it for. Like I said, maybe just gas and groceries, and then pay that off, because it's relatively fixed every month, unless you're having big parties every month, but, or traveling.
If someone's working on improving their credit without getting too crazy and trying to make it into the 700 range, what would you say is a good credit score target for them to hit or exceed before they pull the trigger on buying a house?
I would say, again, this is going to vary depending on loan type, but if you can get mid-6s, go talk to somebody. Go talk to a lender.
Okay.
You have a good shot at getting most things that are out there, even down payment assistance programs.
How much of an effect on an interest rate would be in the low 6s and then getting into the mid 6s?
Oh, tremendous. Yeah, I mean, you could, it may be increased rate and excessive points or cost for that rate or both. The higher you can get the credit score, the lower the points or the cost for that rate, and the lower the rate is. So it definitely behooves you to get the best rate possible. Best credit score possible.
Yeah.
Yeah.
Okay. Cool. So it's a big change then. Just in summary, it's a big change from low 6s or even high 5s, just crossing that threshold into the mid to upper 6s.
Yeah,
as far as cost goes.
Yeah. There's levels every 20 points, right? So it's 640, 660, 680, 700, 720, 740, 760, 780.
Oh, okay.
So those are all the tiers. So if you're on the cusp, you want to try to, we will help you get over that cusp. But maybe you're at a 699. Well, I'm going to tell you what to do to push you to 700 or 720 because it's right there.
Yeah.
And we can do stuff with impactful credit score boosts.
Cool. Good to know. So, 20-point increments. Got it. Next topic would be, what are some tips or strategies you can give somebody when it comes to saving for a down payment?
Budget. Yeah. Literally just budget. Know what your income is, and then know what you're paying every month. And then try to, out of your paycheck, just take 10% and put in an account that you don't have access to or can't touch. Maybe it's another bank in town that you don't have a debit card, you don't have a check for, but utilize that strategy from your check being direct deposited, take 10% and put it elsewhere. And just keep on doing that. And don't ramp up credit cards, just live within your means.
Staying on the topic of down payment, we had mentioned in our prior conversation about like VA loans being zero down or USDA loans being zero down. So obviously if someone can utilize either one of those, that would be ideal. But for somebody who can't utilize one of those types, what would be the minimum down payment that someone should expect?
Well, if you're a first-time home buyer, you get in a home as little as 3% or down payment assistance 0. But anywhere between 3 and 20% down would be a good place to start.
Okay.
20% down, of course, avoids mortgage insurance, and there's ways to look at that.
Yeah, we'll get into that in the future conversation. So, okay, good to know about that. That's an income ratio. So a lot of times lenders will talk about that, or even us as real estate agents will talk about DTI, which is real estate jargon. Can you kind of break down that term, debt to income ratio, for us?
Sure. So it's all your monthly payments on your credit report, adding the proposed debt of the new mortgage with your taxes and insurance and any HOAs, right? Mm-hmm. And then dividing that into your income. So that's a certain percentage. So I would say if you make $10,000 a month, what's 45% of that? $4,500.
Yeah.
Right? So you can have capacity of $4,500 a month and be approved. So do you have a budget of $2,000 a month in stuff, cars, auto loans, credit cards? That means then you have an additional $2,500 you can put towards a mortgage and still get qualified. Now that's very basic. All terms are different with different people and different loan types.
Yeah.
But that's a good rule of thumb. Okay.
Good to know. So someone needs to talk to you to find out, what their threshold is as far as how much more payment they can have.
Right.
Right.
Yeah, because we run it through the AUS or automated systems, and that measures all the risk factors, right? The type of property, manufactured, stick built, the credit score, credit trends, credit history, like are you paying on time? Have you been good and not had any lapses in that? And then it measures how much you have saved, right, for a rainy day. Do you have reserves? That's a good thing usually. It mitigates some bad things in the credit.
Yeah.
And so that measures all that, and I can push those debt-to-income ratios higher if those are all good.
Okay. Mm-hmm. Then rolling into that, since we're already talking about payments, budgeting for home ownership, we kind of talked about it, the same thing as budgeting for a down payment. Obviously, the cost of a house is more than typically 10% of your income.
Sure.
If it's 10% of your income, you're doing good.
Yeah.
So what tips can you give us around budgeting for home ownership? Specifically around like somebody who's coming from, like, let's say they're renting, right? Let's say it's somebody who's not a homeowner yet that's going to become a homeowner and they're currently renting. What tips would you give them? Or how would you tell them how to figure out what they could afford house payment-wise? Not necessarily DTI or debt-to-income ratio-wise, but like,
you can,
what can you actually afford and be like not house poor?
This is what I told my son. I said, listen, you're paying $1,800 a month right now in rent, which is really, really good. But you want to make the next level. So why don't you, for the next year to year and a half, put $700 away in savings to see what that feels like, having a $2,500 mortgage. So you put in an account you can't touch, you can't see. It's a pro tip because you're also now saving money for a down payment, right? Mm-hmm. But now you're feeling that capacity of how you're being stretched. Hey, $1,800 was no problem, but $2,500, whoo, buddy.
Yeah.
Right? But now you know what it feels like, and can you do it? And if you can do it for about that long, 12 months, 18 months, and then it's become easier, now you're ready. Because now you know what it feels like, right? You've stretched yourself. But by the way, you got about $9,000, $10,000 saved because you did that.
There's your down payment.
There's your down payment. Yeah.
That's a great tip.
Yeah. So, and you can do that with any amount. I mean, maybe you're at $1,500 and you want to go to $2,000. So take that $500, sock it away. and don't touch it. It's not there.
Yeah.
Don't get e-statements. Don't do anything. Just let it sit there.
That's smart. Yeah, that's so good because then, just like we said, then that money that was sitting there is now your down payment.
Right.
And that's another tip on how to save for a down payment. And it's like 2 tips in one, right? Because you're saving for a down payment, but you're also preparing yourself for the new mortgage payment.
What does that feel like?
Potentially the new mortgage payment.
Right. What does that feel like? Can I handle that capacity every month?
Yeah. As far as other costs, you've got your mortgage. I'm just trying to think of what other costs there are for home ownership versus renting.
Yeah.
I know you've got like HOA fees. Is that calculated into a mortgage? Or
It's
is that
calculated into
separate?
your debt to income ratio.
Okay.
Now you pay that separately, but in addition to HOA, you should think home ownership every year is going to cost you about 2% of that home value, just in maintenance and things that are going to need to be fixed and or electricity, utilities, etc. So think about that because that's something often overlooked.
Mm-hmm. Okay. And then, if someone does all that stuff, then technically they'll be financially prepared. They'll have a good strategy.
Boy, howdy, that'd be nice.
They need to come in and speak to a mortgage professional.
Mm-hmm.
So if they're here in Prescott, obviously we'd love for them to talk to you, or in Arizona,
or 48 other states.
48 other states. Greg's always available. He's a great resource. But just generally speaking, when someone goes in to speak to their their mortgage professional for the first time, what kind of documentation can they expect to bring into you?
Yeah, I would say this. Bring your W-2s. If you're a business owner, bring 2 years tax returns. Bring a paycheck. If you're a business owner, bring your pay schedule or your K-1s and your W-2s. Bring a bank statement 1 or 2 months. Any investments you have, bring that in as well. And if you own homes, bring in your mortgage statement, your insurance deck page, your property tax bill, and if it's leased out or rented, that lease agreement, and your personal taxes. Now, that was a lot of stuff.
Yeah.
but and it's not that scary, honestly, because I just covered a lot of different things. Like for retirees, we're looking at your Social Security benefit statement letter, which I'll see that you're getting that paid in your bank statement. Mm-hmm. You get a 1099, so we can get one or the other. If you're getting investment income, we just need that 1098, and we need your quarterly statement. But if you have a pension, that's real simple. You just bring the pension letter, and you get a 1099. So it's not like it's a ton of stuff. It just depends on who you are financially.
Yeah, that makes sense.
Yeah.
Yeah, 'cause somebody who's retired is not going to necessarily have a W-2,
Mm-hmm.
or, they can have
You'll
if they got business ownership, but they're probably not going to have, if they're truly retired, so they're not going to have W-2, they're not going to have paychecks, they're not going to have K-1s. So what about somebody who has, who wants to get a VA loan? What specifically do they need to bring you?
I can look up their certificate of eligibility, and most lenders can.
Okay.
So
they don't necessarily need to bring that into you. You can look it up.
We'll ask for it down the line. We'll need it down the line. But initially, we work with the VA to get that stuff, and it's super simple. It's all streamlined. But same thing. If they're working, we'll need a pay stub, W-2 for 2 years, right, and a bank statement. That's pretty much it. Just come in, and then we'll look at that and go forward.
I think that's kind of a wrap on financial preparedness and strategy. Anything we missed on that?
We covered credit. We covered income. We covered kind of assets in a roundabout way. Mm-hmm. I think we're all right.
Cool. Well, we'll come back with some tips and tricks of, what Greg's got up his sleeve on how to get a mortgage payment down a little bit. No pressure. We'll be right back.
No routes.
Thank you so much for joining us today on the Northern Arizona Real Estate Podcast with special guest Greg Riordan of Legacy Mutual Mortgage. Unfortunately, we ran out of time today to cover lending strategy tips and tricks that Greg has, so you're going to have to join us next week as we go over that. We'll pick up where we left off. Until then, I hope you have a rad week.